Good morning, everyone. Welcome to this update for global stocks and commodities for the 23rd of February. Well, I guess it's been another week where virus panic has certainly escalated another notch, thanks to the media. And the normal human being's fear response naturally kicks in. Nothing wrong with that. That's always going to happen. It's the way that we're wired. But look, this fear about where the virus might go and how it might impact global economies, that's going to pass. And investors who can look through this and keep their heads during this period have done very well out of some amazing growth stories if you really tapped into where the opportunities are. I can't remember a time when I've had so many high conviction businesses to buy. Now, over the last 12 or 18 months, I've had a lot of terrific winners. Yes, there's been a few that didn't work out along the way, but overwhelmingly, it's been an extremely positive period. And I've got a pipeline that still is really exciting of new businesses and technical disruptors that are coming through. It's not at all difficult to buy businesses that are highly resilient to global events. It just isn't. Everyone thinks when these panics are on that absolutely every business is going to get affected. Yes, the share price might get affected in the short term because of sentiment, but the business itself doesn't get affected. There are businesses out there that rely on just unstoppable megatrends and/or they're in defensive areas of the economy, things like education. That's not going to go away. Payment technologies is not going to go away. Focus on the environment is only going to keep getting stronger and stronger. These are businesses that are solving a pressing need, and they can do it in an incredibly efficient and cost-saving way. So why shouldn't those businesses do well? So I guess my message this week and pretty much every week is to focus on the things that you can do, focus on the really exciting opportunities, and as much as possible, just try and ignore the coronavirus or the trade war or something in the Middle East or, whatever it might be. Try and ignore that because that's not the big picture. They're just transient things that come and go. If you stay focused on the big picture, you can do extremely well. All right, so in this update, I really just want to highlight what an extraordinary future that we have. This is the most exciting time to be alive and to be investing, and it just requires a focus on the relevant things and having a good mental attitude. Don't get drawn into all the negatives that are out there. I'll touch on the normal stock and commodity trend updates and portfolio analyst last week. I looked at how investing has changed over the last decade or two, and it really has changed very significantly. And it was very interesting during the week to read a piece from, probably one of Australia's most conservative value kind of fund investors. They would not do anything out of the norm. But even now they are starting to acknowledge that they actually should be looking more at growth stocks and that they should be taking account of momentum and not just being focused on trying to buy undervalued stocks. And that is quite a shift for this particular major fund manager. So investing has definitely changed, and I think probably changed for the good. And a large part of that is because of technology. And there was also obviously an update, which I do pretty regularly, on the 10-bagger portfolio. Now let's look at American stocks. The S&P fell by 42 points on the week, which was about 1.2%. And we've got to get a consolidation at some stage. Let's face it, the S&P just can't keep going up at the rate that it is. But the consolidation can be quite mild. It can just be a bit of a sideways band, and to me, that is the probable outcome at the moment if you look at the market action. So a consolidation, yes, but a correction, there's just absolutely no basis for it. There's no fundamental basis, and you cannot see any basis for it in the charts either. Technically, as I covered last week, we had a major breakout in 2013. We had another breakout in 2019, and that's what the charts are doing. That's what the trends are doing. And just look around you. There's just amazing technological advancement everywhere. Whether it's 5G, whether it's artificial intelligence, whatever it is, driverless vehicles. Technological advancement is just absolutely astounding, and so naturally there's going to be a lot of companies that are going to benefit from that. Now, in the US, earnings season is winding down. We've seen a 66% beat rate at the earnings level, which is still pretty good. Well, I'll show you a chart in a minute that puts it in perspective in the longer term. And of course, the tech sector has been leading the way with the most robust earnings and the most robust advances. So there's really nothing to do except to continue to follow the trend. That's it. Keep it simple. And at the moment, the trend is still up. Now, the US dollar extended its recent gains up to 99.26, and that's an interesting chart, which I'll have a look at. And the 10-year yield fell during the week down to 1.46. So the upsurge in fear about the virus had a bit of a flight to safety into bonds, into the US dollar, and into gold as well. All right, let's take a look at some charts. So this is the S&P. This was the point that I spoke about 2 weeks ago, 3 weeks ago now. And I said, as long as the 50-day moving average holds, then assume that it will. And the market has done nothing but go up from there and set a new all-time high. Now, what will happen this time round? I really don't have any idea. At some point, this upward trend will go into some sort of consolidation. That consolidation might be quite narrow, perhaps something that looks like that and go on for several months. It might be something deeper that goes on for a longer period, perhaps 6 months. I have no idea. But until the charts look a heck of a lot worse than they are now, then I'm just assuming that we'll continue on with the trend that we've got, just managing things appropriately, buying into dips. Probably with the market getting a little bit nervous, you probably want to buy into a bit of a bigger dip than perhaps would have been the case a few months ago before the virus outbreak occurred. So wait for a bigger dip, take some profit off the top when stocks get ahead of themselves, and just manage things conservatively. And I think you're probably going to do pretty well. Just let's have a look at the big picture here. So this is the S&P. So this is the peak in 2000. This is 2007. And then you can see the incredible breakout that occurred in 2013 and how far we've gone since then. And then just recently, of course, we've had another breakout, which I talked about last week in 2019. So it could be that after this pause and consolidation, we're off again. And I went back and I had a look at the period in the 1990s, because this is a period that is not too dissimilar in terms of chart patterns. So in the early 90s, coming out of, so here's 1987. People make such a fuss about 1987, but just look at it in the bigger picture context. It was one month down, 2 months down, and then sideways for some time, but then pretty much up from there. So in the early 90s, we had a consolidation that lasted from, let's say, April 93 through to about February 95. And then after we broke out in February 95, a lot of people were saying then that this can't go on. Look how far we've come since the 1987 crash, and this just can't go on. Yet it did go on for another 5 years, and it took the S&P from 500 points to 1,500 points. It trebled. Now, I'm not saying that we're in the same point now that we were in 1995, or that we've got 5 years of a bull market ahead of us. but equally, I don't think you can say that we won't either. I think there's every chance that we could still have an extended period of gains ahead of us. So, that's just a big picture perspective to bear in mind about where we're at right now. Now, if we look at the US dollar, so we were in an uptrend. We dropped out of, this is a weekly chart, we dropped out of the uptrend at the end of last year. And I talked about that, the fact that the futures market was set for some significant downside in the US dollar, that Trump wanted a lower US dollar and was pressuring the Fed to get it. As it's turned out, it's been a false breakdown. We've bounced back into the range. And so now the question is, and I was posed this question by a member through the week, which was a very good question in hindsight, and that is this going to continue in an uptrend, or are we now in a period of consolidation? So is this now a sideways band? And the answer I gave was, well, if and when we get a breakout above this peak here, the October peak, then that would indicate to me that the uptrending channel is going to continue. But until that time, then it's possible that we could also be in a consolidation between, say, 96 and 99.5. Now, as you can see through the week, the US dollar did in fact pop out and form a new medium-term high. In fact, it was the highest level since May of 2017, so the highest level in nearly 3 years. But then it closed down again, and almost all of that was on Friday. So it's a bit undecided at the moment in terms of currency. Now, that has ramifications, of course, for the value of the Australian dollar and for the value of gold as well. So that's why that one's important. Let's just look at the Australian dollar while we're here. So we've now had a significant breakdown in the Australian dollar. We broke down, finished in fact, we dipped just under 66 cents during the week. And this is now the lowest level since, I've got to come all the way back over here to 2009. So it's the lowest level in 11 years for the Australian dollar. And, you've just got to respect the trend. The trend is down. It doesn't matter what the fundamentals say. The trend is absolutely down, and quite strongly so. Okay, so this is the results for the US earnings season to date. So on the top, we've got the percentage of companies in the S&P that are beating earnings estimates for the quarter. And you can see over here, the red bar shows 66% of companies beat. Now, it's about the middle of the range, maybe slightly above the middle of the range, but it's certainly not poor, which is what a lot of people have been suggesting, that companies would struggle to get any earnings growth. But what is impressive is the revenue growth, and this is really important because companies can manufacture can get their earnings up by doing share buybacks, by doing some fancy accounting, by cutting costs, but all of those things have got a limit to them. But the one thing that every growth company needs is revenue growth. And look at the revenue growth in the last quarter compared to estimates. 65% of companies have beaten estimates on the top line as well, and that's quite high. In fact, it's one of the highest. It's one of the 5 highest readings in the last 6 or 7 years. So that's been an excellent result, and that's very encouraging. Turning now to Australia, the Aussie dollar, as I said, was sharply lower to 66.28. It actually got down to 65.85 at one stage, and it's broken some key support. Our index rose 9 points, but it'll probably be down tomorrow morning. And there was just profit taking everywhere, even in the really good growth stocks, the high flyers that have gone up hundreds of percent. Everything pretty much got sold down. There was almost nothing that was spared that I could see, and that's normal. you get to a point where investors, traders get nervous, a bit of profit taking starts, triggers a few stop losses, and starts a bit of a spiral. And that's always going to happen. But certainly the stocks that I'm interested in continue to look very solid from my perspective, and the earnings reports that have come through have been extremely good. This is where having real clarity about what you're doing, what is the purpose for every trade that you do or investment that you do, and what is the process by which you get in, the way that you manage profitability, the way that you manage exposure. What is that process? You need to be really clear about that process. Don't just make it up as you go along, as most people want to do. And most people want to do that because we hate to be put into a straitjacket. If we make up a set of rules and get a process for ourselves, then we sort of feel like we've constrained ourselves, constrained our creativity. But you need that process to guide you when things get a bit uncertain. You need a process to fall back on. So very, very important, that aspect. Let me just look quickly at the Australian market. So there's the ASX 200. It's since the breakout, it's been in a pretty good uptrend, and despite the fact that banks are at really historically high valuation levels at a time when there's a lot of headwinds, which sort of doesn't make sense. This is what the Australian market has done, but I certainly see a lot of risks in the Australian market, that's for sure, in the top 100 stocks. All right, let's look at precious metals now, because gold rocketed up by $60 and finished at 1644, so a massive week for gold. And that was despite a somewhat stronger US dollar, a stronger stock market. And normally, if stocks are going up, then the requirement for gold as a safe haven isn't there, so gold's not going to do all that well. But we had stronger stocks and stronger gold. It's all really curious when you consider and add into that the fact that GDX, the major gold stocks, are not leading either. Now, there are many small and mid-cap stocks that are doing well, but the majors are not leading the way either, as they normally would. And the futures market has not rebalanced itself either. The number of long contracts compared to the number of short contracts is just at all-time extremes, crazy extremes, which means that it only is going to take a small trigger to get a cascade of selling in the futures market. But for some reason that I can't explain, that has not materialized. And it really is extremely unusual. So for me, there is only one logical explanation, if you want a reason for it, because you can track the amount of investment funds going into GLD, which is the gold ETF, the world's biggest gold ETF. You can track that quite readily in the States, but if there's been buying in the Asian markets, if the Asian markets are getting proportionately more concerned about the coronavirus than other parts of the world, then that's a bit harder to track. So it could well be that there's money coming from that source. But look, we don't really need to know why. We just observe and respond. So precious metal stocks, I said last week something had to give, and it did. And we got a significant move in gold, and we certainly did get a response from GDX. So let's take a look at those markets. So there's the gold price on a daily basis, and as you remember, I was looking for the completion of this ABC correction. I guess perhaps it did do that, but it didn't even, the C leg didn't even really get down and go to a lower point, or even down to that point. We got a slightly higher low, and then it's just absolutely taken off. So from a purely technical perspective, we now have a breakout in gold, and that was quite a significant level. Now the next resistance comes in around 1790, and then the all-time highs. And the way that it's going, if you just step back and look at rate of gain since October 2018, so that's around about 18 months, we've gone from 1200 to 1650 in 18 months. That's a pretty major gain. So gold is certainly well and truly broken out now. If we look at it on a weekly, you can see just how steep that trend channel is. Going to GDX, reflecting the world's major miners, and we finally did get a response. We've broken out of this triangle, and we've got some upcoming resistance here at 31.7. But then after that, we've got a long way before we encounter some other significant resistance. So maybe, just maybe, gold stocks are well and truly on their way at the major level. But at the smaller level, there is some terrific activity, particularly in the Australian market. And Northern Star, my favourite gold stock, has gone up from $9 to $14.60 in just a handful of months. So there's certainly been some terrific action in the gold market. Turning to other commodities, copper was steady at $2.60, no change there. The big picture long term, let's say over the next 5 years, particularly with electric vehicles, remains extremely supportive. But in the short term, it's being held back by by concerns over global growth. West Texas Intermediate crude rose mildly again against the trend of the US dollar. And given the accelerating surge in alternative energy momentum, one's just really got to wonder about the growth future for oil, certainly, and to a lesser degree gas. We've just got, obviously, wind and solar has been around for quite some time, but we're now getting advances in battery storage. We're now starting to get a bit of a greater acceptance, I think, and rightfully so, that if you use gas as a backup mechanism, electricity generating mechanism for renewables, that you can actually commit to contracting more of your renewables. So because gas can be brought on very, very quickly and fill in the gap. So, and then we've got, of course, technological advancement in, perhaps the use of hydrogen and many other technologies as well. So there's been this incredible surge in alternative energy, and I just sort of look at, well, what is virtually not negotiable for oil, and it's probably only aeroplane travel that is really, the technology doesn't exist to replace aeroplane travel at this stage, but pretty much everything else, the technology is either there or it's not far away. So you kind of got to worry a bit about the future for oil. There's the spot copper chart, so no real change there. Nickel came off a little bit during the week, but is still reasonably buoyant because of the dynamics around Indonesia. So my final thoughts for this week, and I just pose the question, why can't this be like the mid-1990s? Why can't this be like 1995, where we've still got this huge bull market ahead of us? No, I'm not saying that it will be. I'm not predicting that it will be, but I'm just posing the question, why not? From a technical perspective, we've now got a breakout that looks very similar. From a technological perspective, there is so many exciting things going on out there that are going to advance medical science, that are going to advance economies in all sorts of ways. Why can't this be like the 1990s? Don't get drawn into the short-term focus on the coronavirus, because it's just misleading you. That's not the game at all. We've got an amazing period ahead of us. I've never been as positive and excited about the future because of the technology. Many companies are going to lag or fail, but the innovators are going to grow incredibly, and they're going to create enormous wealth for investors. So forget about the coronavirus or whatever else is going on in the short term. Focus on learning about these companies and getting into these companies, and getting a process that you can abide by when markets get very volatile. How will you navigate the next few years can really set you up financially extremely well. Be guided by the market, not by the news. Have a look at what is, and just go with that. Portfolio analyst this week. I've got a new high conviction stock that I'm very keen on, so I'll be introducing that to members. And let's see what's ahead of us. I've got a feeling it's going to be a bit of a mixed bag this week. It just feels the way the US market finished, just feels like we're going to get a bit of up and down, positive one day, negative the next, for a bit of a period. But, the good stocks will come through that quite well. There's my contact details for anyone who's not a member of any of my services, and I'll be back with you next weekend. Cheers.